Treasury has kept changing and evolving, even more so in the last 10 years. Whether it's coming from the regulation, market volatility, technology, geopolitical events, we always had to adapt our systems, our processes, but also our organization. If you look at what was composing the Treasury team's activities a decade ago, it was primarily cash, FX, and bank management, very traditional and basic. But since then, I've seen more and more companies' activities being shifted to Treasury, acting as a plug-and-play solution for when we are not sure where it belongs to. However, it does make a lot of sense to me. Trade finance, for example, where we deal with sometimes complex security instruments like bank guarantees, letters of credit, corporate guarantees, surety bonds. These have a direct impact on the cash flow, as customers won't pay until they received it, for example, but it also generates significant risk for our companies, which is often misunderstood and therefore underestimated by the sales team. Treasury has been the risk management department for so many years, it makes sense to add this to their scope. Then the order to cash function, assessing a customer's or supplier's financial stability and strength before we commit to an order, to payment terms and milestones, is quite fundamental but overlooked at because of speed of execution and the fear to lose contracts. However, what is a sale worth if your customer doesn't pay you? What is the point to select a great supplier if in the end they don't have the capacity to produce your goods? You need financial specialists that can assess that risk upfront, analyzing the balance sheet and P&L of our partners, so that the proper advice is given upfront, avoiding issues later on. This does directly impact the cash flow of the company once again. All those activities interact, whether we want it or not, with Treasury and ends up being taken care of by them somehow. So why not plugging those together to gain efficiency? Treasury has always been acting as a catalyst of change and transformation in an organization and is naturally proposing improvements that can have deep consequences for the company. All those functions put together can facilitate missions of the treasurer to lead those changes with more efficiency and less layers. Another key activity that we see gradually moving to Treasury is the accounts payables, AP, function. This is, for me, the most obvious and easiest to merge with Treasury, given the immediate impact it has on the cash forecast and liquidity management. There has been finger pointing and back and forth between Treasury and AP. For example, duplicate payments to recall, supplier payments made in an organized way, wrong or missing information in the payment batches leading to processing delays, rejections at the bank side, that Treasury needs to spend time on to investigate. Even worse, poor static data quality of the vendor database, leading to error and sometimes fraud. And guess who is called and to blame to those situations? Treasury. AP must be part of your Treasury department to ensure both teams are met, both team needs are met and known by both. When AP is struggling to understand what went wrong with their payments, when AP is struggling to know if this invoice can be paid or not due to lack of visibility on cash, when AP is struggling to understand why this transaction cannot be reconciled, when AP is struggling to find where the bank statement is at, or when AP is having issues having to prioritize some supplier and not others because they are wrongly assigned the liquidity manager role. That's where Treasury come into play and save them, acting as the payment and bank connectivity expert. Both teams have a lot to offer to each other, and they often face the same challenges internally. And one of the biggest being that they are both misunderstood and their role underestimated. AP, like Treasury, can be a strategic function. Strong process to guarantee quality static data, strong vendor bank account onboarding controls, plan and regular payment runs, invoicing proper coding and approval monitor, aging assessment and proactive escalations. And last but not least, automation and the use of AI. Automation in AP makes a lot of sense. If you compare it to a Treasury well-known activity, Imagine we all do payment manually by entering the payment on the bank portal or manually. In AP, you often receive invoices per email, which the team will then open, manually key in on the ERP, possibly with mistakes, sending to approval, rejecting, re-enter, re-proceed with the payment run. Then there, the team will need to ensure we use the right vendor account, the right company account, and that the payment batch is properly approved. So here again, to monitor proper release of the batch, fingers crossed that everything after that exercise, the supplier are at least paid on time or slightly late. This is insane when you start to have thousands of invoices every month. So Treasury has moved from those manual payment to fully automated processing with file upload to the TMS and release to the bank, or ERP files sent through in straight-through processing mode. AP is now taking that step, using automation tools such as RPA, Robotics Process Automation, and OCR technology to read and extract data points from PDF documents, then putting those into the ERP automatically to speed up the data entry and invoice submission. AI can now also offer a more accurate way to code those invoices using the right expense type, the right financial dimensions, etc. For once, regulation and compliance requirements are also bringing its sets of efficiency for the AP function, who must be embracing those, e-invoicing being one. So by 2030, all EU countries will have to be able to submit and receive invoices electronically. This means invoices come in a dematerialized format, automatically integrated into the ERP. The AP team then spends more time in analyzing and monitoring versus performing low added value tasks such as opening PDF documents, coding invoices manually. So we must see this as a clear and highly added value activity for the whole organization and not merely another regulatory requirement. If you haven't started to think about e-invoicing nor put this on your roadmap or budget, it is really time to do so now. The agenda is very tight, and e-invoicing solutions providers and implementation partners is far from being transparent, if you ask me. It is a quite tedious exercise to question providers, go through demos, often lacking transparency on who and what sits behind the curtain. Doing an RFP for a TMS provider is much easier than one for e-invoicing. The integration and native connector, if available to your ERP systems, is a key component to get adoption internally, especially with your IT department. But the solution must ensure it can accommodate each EU country's specific requirements, use the right network that are widely adopted, etc. Then comes the question for data mapping. Who will perform this? The implementation partner, you, where it sits, how many internal resources do I need, etc. So the cost element is quite surprising as well, wondering how companies can cope with that, by the way. Providers have seen probably a niche effect and price their solutions accordingly. And if you cannot offer it to you, then you have the possibility to externalize this to a company who will receive and submit invoices electronically on your behalf, with a higher long-term cost, of course. But again, this is not just about cost. It is about great efficiency gains. When doing your ROI on invoicing, please do consider the automation piece and huge time savings made to your whole organization.